Short exercise 14-9, bond issued at par. Beck Company issued a $110,000 6.5% 15-year bond payable. Journalize the following transactions for Beck Company and include an explanation for each entry. A. Issuance of the bond payable at face value on January 1st, 2025. B. Payment of semi-annual cash interest on July 1st, 2025. C. Payment of the bond payable at maturity, assuming the last interest payment had already been recorded. Give the date. Record debits first, then credits. Select explanations on the last line of the journal entry. So here, for the first part here, we have A. Issuance of the bond payable at face value on January 1st, 2025. So this first one here on January 1st, 2025, we issued the bond at par value, so that's the 110,000 bond. And since we issue them at par, that means we received the full $110,000. So we're going to go ahead and increase cash with a debit since it is an asset. So that's 110,000. And then we got the bond payable in return. So that's going to increase our bond payable, which is a liability, which increases on the right with a credit. So we'll go ahead and input 110,000 right there. And then for our explanation, this was when we issued the bonds payable. So let's go ahead and input that. And then we can check the answer. Excellent. So part A was on January 1st, and now in part B, we are July 1st. So how often do bonds pay interest? Twice a year, every 6 months. So it is now July 1st, so 6 months later, and we have to journalize a payment of the semi-annual cash interest. So we have to calculate how much the cash interest is going to be that we had to pay out. So the formula is principal times rate times time. So let's go ahead and pop open our calculator down here. So the principal is that $110,000. Then our rate is 0.065, 6.5%. And then our time is divided by 12 to get the 12 months. And then we're going to multiply that number by 6. And that gives us $3,575 there in interest expense. So we can go ahead and get interest expense added as the account for $3,575, and then we're going to pay that with cash. So we can go ahead and credit the cash. Decreases here with the credit, we are paying the cash. And then we have to input the explanation, which is paid semi-annual interest payment. And let's go ahead and check our answer. Nice work. So for C, payment of the bond payable at maturity, assuming the last interest payment had already been recorded, give the date, all interest has been paid to date. So it has been 15 years. And how did we know it's been 15 years at this point? We have a 15-year bond payable. So 15 years from January 1st, 2025, you can do the math there, add 15 to 25, it's going to be January 1st, 2040. So notice that the months here show up as well, so be careful you don't hit July. So 15 years later, we have to get rid of this liability, so we have to pay our bondholders the $110,000. So what happens to this bonds payable when we pay off this debt? It's going to go away. And how do we make a liability go away? We have to lower it, which means we're going to debit bonds payable. So let's go ahead and get that here for $110,000. I'm just going to go ahead and get that in there and then pay cash. And cash is decreasing here with a credit since it is an asset. And then lastly, our explanation, we retired bonds payable at maturity. We can go ahead and check our answer. Fantastic.